In this week's video, we'll review the latest charts to help us answer the question, is the new COVID variant a game changer for stocks? Given the new information that came to light over the Thanksgiving holiday, and in the context of the worst losses in Black Friday history, it's fair to ask and answer, how much damage has been done to the market's longer-term trend? This is the monthly chart of the S&P 500 between 1982 and 2009 that we've covered in past videos. This is that bearish look that we want to avoid, the peaks in 2000 and 2007. Relative to the blue 10-month moving average, these periods look discernibly different from these periods. And when the market's in a very strong uptrend, it's not unusual for long periods of time, in this case several years, for the S&P 500 to avoid closing on a monthly basis below that 10-month moving average. This is the same 10-month moving average shown in blue here the day before Thanksgiving. And if we fast forward to the close, November 26th, the day after Thanksgiving, we can see from a long-term perspective there's not much change on this chart. How about the daily chart? We've been using these examples as references in the past. Day before Thanksgiving, the close November 24th, we had that full-bore bullish look. How much damage was done on Black Friday relative to the trend? Given this is the same chart after the close on November 26th, keep in mind the market closed at 1 p.m. Eastern Time on Black Friday. This look is not particularly alarming. However, we could have said the same thing in the early stages of the COVID plunge, something that we've mentioned numerous times in past videos. Also, trading activity on Friday, November 26th, somewhat concerning from a volume perspective. Volume was extremely high relative to average volume, especially considering it was Black Friday and a shortened session. And we can also draw parallels to volume, this COVID peak here, and the volume that we experienced in the early stages of that peak relative to Friday's session. If you want to round this number up here, it looks like we had a 90% down day. Like these data points over here, that's telling us to pay much, much closer attention heading into next week. And while it may seem like a distant memory, we did have some wild swings Monday of this week before Thanksgiving on Monday, November 22nd. And more specifically, some wild swings intraday relative to growth positions and value positions. After the Black Friday session, those concepts may still be relevant because we saw something similar on a shorter time frame in the last few hours of trading on Black Friday, November 26th. You can see here VTV closed, here's the bar, near the high of the session. This is the S&P 500 up here. It closed closer to the low of the session. Here's energy here. It did close for the most part at the session high where my cursor is. Value-oriented financials, same thing, closed near the session high. Oil and energy exploration, basically at the session high. Conversely, technology closed closer to the session low. Why is that relevant? Because these positions tend to be more economically sensitive. And they also tend to perform better when interest rates are higher rather than lower. You can make an argument, this green here relative to the range for XLE, this green here relative to the daily range on Black Friday for XLF, and this green here for VTV, show some signs of economic confidence intraday. It's not going to mean a whole lot if we don't get some follow-through next week. But since it was similar to what happened on Monday, November 22nd, the studies that we performed based on this session still may prove to be helpful, and we'll cover them later in the video. It's a holiday weekend. We'll be moving quickly. Feel free to use the pause button on your video player. This is the COVID plunge here in 2020. This is equal weight S&P 500 RSP relative to TLT. This is the look of daily RSI down here. Here's the same chart prior to Thanksgiving. Instead of a lower high here that we had in February of 2020, we're knocking on the door here of a new all-time high, and RSI didn't look too bad. If we fast forward to Black Friday after the close, there's damage here. We have somewhat of a failed breakout look now. That's not particularly encouraging. However, We're still in this multi-month range here and still above this upward sloping trend line. In terms of the trend of this ratio, point A to point B, not a lot of damage done yet. If we get a big gap down on Monday morning and we move into this area or this area here, we'll learn something in terms of bearish probabilities. Also noteworthy, RSP relative to TLT, that's a laggard ratio. What do we mean by that? The leadership ratios look better. The market is performing better than RSP in recent months. SPY TLT, here's the look after Black Friday. Right now it looks like a bullish breakout and we're coming back and testing that breakout. So this chart looks even better. Vulnerable? Yes, because if you move down here, things would start to change quickly, and if you move down here, we'd become even more concerned. Also noteworthy, this rally from point A to point B, really just coming back to the 38.2% retracement of that A to B move. Not making any predictions about what this chart or any other chart in this week's video is going to look like next week. We're making comments based on the charts in front of us. This chart doesn't look too bad. It does look more vulnerable. So this is the market relative to TLT. One of your leadership groups, growth, looks even better. This is VUG relative to TLT, well above that box, multiple month period of consolidation. Stayed in that upper side of the box, most of this consolidation still taking place above an upward sloping 200-day moving average. Commentary from the SPY TLT chart applies to this chart and to this chart in terms of what we would learn if we move down here and down here. If we drew a trend line here, here, and here, come into this area here somewhere, don't have a lot of damage to this ratio either yet. However, we could have said something similar relative to the market in some of these ratios in mid-February of 2020. Now let's shift gears back to the chart of the S&P 500. And in past videos, there's the COVID plunge here. This is, all things being equal, you don't want to see this on Monday morning of next week. This is February 19th of 2020, so this is the peak, pre-COVID peak. And then on a Monday morning, February 24th, you get this big gap down on a ton of charts. Somewhat surprisingly, on Black Friday, the chart of the S&P 500, and this is a zoomed-in look of this area here, didn't get a gap down. If we were to get a gap down and then hot knife through butter look through the 200-day moving average, if we can't make a stand near the 200-day, our concerns would increase. As shown here, a gap down in isolation isn't necessarily the end of the world. You have to take a look like this. This is one piece of the weight of the evidence. This doesn't look too bad. If you pause your video player and compare these figures here, so this is an up day on the S&P 500. I believe this is a Wednesday. This is a Thursday. This is a Friday. This is Monday, February 24th. The volume on Black Friday is telling us to pay closer attention and to take this seriously. But in terms of the chart in front of us, not a lot of damage to the trend at this point. If we take the same chart and add the 100-day moving average in green and the 150-day moving average in purple, you can see in recent months, for the most part, the market's made a stand above that 150-day moving average. We did it here, and we did it here. It comes in the present day around 4,400. Made a stand here, made a stand here, made a stand here, made a stand here. Had a gap down here, and then made a stand in that general area. The big difference here was we couldn't recapture these MAs and move into this area here. That's quite a bit different relative to what happened in a bullish outcome case here. There's no magic formula. You have to look at everything and consider the weight of the evidence and the data, and that's what the model does. There's nothing magical about moving averages. There's nothing magical about Fibonacci retracements or areas of possible support and resistance. All of them are simply reference points. This is a noisy chart. These horizontal lines are A to B fib moves. So this A to this B, this A to this B, and this A to this B. And we've got the same 100, 150, and 200-day moving averages on that chart. Moral of the story, there are several areas Past resistance here, past support here around the June lows, past resistance here. Several possible areas of support between price as of the close on Black Friday, including this high here, and the 200-day moving average shown in red. Easier to do less if you can hang in this area here and make a stand. Gets a lot harder to do less the further you move in this direction here. Chart of IEF was relatively interesting on Black Friday. Here's the intraday high where my cursor is. We finished near the intraday low as far as the range went. That's a gap up there, so that's a big move. You still had a great day in IEF. In terms of the daily range, though, you finished near the bottom of that range. Also noteworthy, fear was such that we couldn't even exceed the high that was made earlier in November, and the high, intraday high here on Black Friday, was well below this high, and this high made way back in August. This is somewhat of a fear gauge here. Tried to make a run at the 200-day in red. We were above it most of the session and closed below it. Kind of an indecisive look here, but maybe a little bit better than you would expect. If we look at the chart of TLT, you can see TLT is closer to a breakout here. This is the same general area here and same general area here. This is just TLT. If TLT can break out of this box, it gets a little more concerning. If IEF can get here, it gets a little more concerning. But really, IEF would need to exceed this high in August to show us some type of different fear look. As we've shown in past videos, small caps have been a laggard in recent weeks and months, even after this breakout attempt. Thus, it's noteworthy they really haven't shown significant breakdown yet. This is an ugly gap down Black Friday on IWM. You can see we have flirted with the 200-day moving average in the recent past, but every single time we made a stand. So we'll learn something if small caps can't retake the 200-day relatively soon, and more importantly, if they give up these two horizontal lines here where my cursor's moving around. This is based on these lows, prior support, and there's a gap here. Also some reference points on the bottom using RSI as of Friday's session. Seems to have held okay for now. But like many of the charts, even the weaker sisters, we're still moving back into a long-term consolidation box. Gets uglier if you get out here. This is value versus growth after the session on Black Friday. Point of the exercise, value still is a laggard relative to growth. Thus, you can make an argument it's somewhat encouraging that value in isolation, VTV, had a breakout here, somewhat of a retest look here, and on Black Friday we came back to that same basic area. So this, and this. So even the chart of one of our laggards here doesn't look that bad. It's still above this upward sloping trend line here, and still above an upward sloping 200-day moving average. So we have some evidence on Friday that's not particularly concerning, and we have some evidence that's starting to check bearish boxes. Let's circle back to this value versus growth topic. This is growth versus value, Monday, November 22nd. Wild session here. Here's your open, here's your close. Here's your open for tech. Here's your high of the day. It gave it all up and then finished near the low of the session. Once again, you can pause your video player here. This tweet and this third-party research tells us these types of moves are rare. We've only seen 10 of them since the major low in March of 2009. We wanted to focus on these cases here. Keeping in mind, this wild swing or signal occurred Monday of this week, and something similar occurred intraday on Black Friday. So question number one. In the past 10 instances during the bull market after March 9, 2009, how did the stock market perform after something like this? The answer, looking at the 10 most recent cases, on average, quite well. 90% of the cases were higher 3 months later. The average gain was about 5.5%. The median gain was about 8%. It's this COVID period here that would be more concerning. We also wanted to ask and answer these questions here where my cursor's moving around relative to these 10 dates that were identified in this tweet and in this third-party research. So to answer these questions, we'll take the summary portions from a table like this and put them all on one page. The answer to the questions on the prior page are basically, the NASDAQ finished in first place, growth was second, the market was third, and value was fourth. All of them did well. However, these are average and median figures. There's a lot of pain in this case, this case, this case, and this case. Thus, if you look at this a little more closely, it's somewhat of a binary outcome. These cases have a lot of pain. The remaining cases, there was not much pain at all. Thus, we wanted to know if the market holds and we avoid a look like this over here, and that's to be determined, but so far we have avoided this type of look. What do the maximum drawdowns look like in these two cases and these cases here? We really don't even need to perform the analysis for this. We did, but we know these ones are ugly. In the present day, if we have a case like this, or this Black Friday chart, for the most part, is going to morph into something like this, and we have a way to handle that and identify that. If we can avoid this, it's helpful to know what the drawdowns look like in the other cases. So this would be your bearish scenario. This would be your bullish scenario. It's also noteworthy that these studies were completed before Thanksgiving. So we'll look at the maximum drawdown for this group and this group, removing this group. If you want to know what the maximum drawdown looks like in these cases here, it's ugly because they all end up coming down to this low here. If we look just at these cases and these cases, it tells us to keep an open mind about better than expected outcomes. Because the 39-day drawdown, and the reason why we use 39 days, that would take us to year-end, hypothetically, 12/31/2021. The average drawdown was about 2%. The median drawdown was about 2.7. Not a lot of difference if you could look out a full year from the date of the signal. And the date of the signal in 2021 would have been Monday of this week. So if we use these one-year drawdowns and we use the recent high in the S&P 500, if we can avoid something like this and avoid something like this, this is what the other cases hypothetically looked like. We've exceeded two of the maximum drawdowns, and we've come down near this one, and this one, and we're also above the 38.2% retracement, just looking at this A to B move off the October low. As always, we're not using these to predict that the market's going to hold above these lines or not hold above these lines. They're a reference point. If we do hold above these lines, we look more like these favorable cases. And if we don't hold above these lines, and our present day chart, Black Friday, starts to morph into something like this, then that would make us even more respectful of these cases. We have somewhat of a mixed bag here. Unequivocally, no question, we had an ugly Black Friday session. Got a lot of reference points heading into Monday's session, and we've got enough hard data in hand, ugly hard data in hand, telling us it would be prudent to be prepared heading into Monday's session, and we will be prepared. But this look here, and the look of the monthly chart after Black Friday, tell us to keep an open mind about better than expected outcomes. This is the chart in front of us, November 26th. This helps us keep an open mind about the possibility of really, really bad things happening. As always, we didn't change anything from a strategy perspective on Black Friday, and we don't have to change anything heading into next week. We've got plenty of bull-bear reference points to manage against next week, plenty of data to manage against. Even though the Black Friday chart really doesn't look that bad, never hurts to be prepared. If we prepare bearish contingency plans and the market holds next week, we just ball those up and throw them in the trash can and move on. We all know the only way that any of this works is if we trade the chart in front of us and head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.